All right, welcome to the third option bootcamp session. And I'm going to share my screen with you guys and let's get started. Tell me when you can see my screen.
Yeah, go ahead, Dan.
Okay. What we're going to do here today is here are the different trades that we're covering in this session in the 7-week bootcamp. The first session, we learned how to sell naked puts and use the wheel strategy to turn it into a covered call. In the second session, we learned how to sell naked calls on something that you're bearish on, and then do the reverse wheel. So you can turn around and sell covered shorts on those same positions if it gets exercised. And if we play long enough, TJ, you might get a chance to sell a covered short on your GameStop position. Today, we're going to learn about how to sell poor man's covered calls. And that's kind of what we're going to cover. That's the trade we're going to cover today. And then next week, it's poor man's covered puts, which is a bearish trade. And then strangles and straddles. And then iron condors. And finally, diagonals. So what I want to say is it's been a crazy week in the markets. And I don't know if you guys are trading it for real or if you're actually in the game, but I want you to notice here, and let me use I love to use my pointer here, my laser pointer. If you look up here, what happened, this was early in the week. This trough here is 1.5% down. And then it went an additional 1.5% down. And then it went 2.3% peak to trough up, an additional 1% up to hit some all-time highs. This is in SPY. And then today, what you experienced is a drop down of 2.8%. So it's been a roller coaster. And this is also the VIX. So you can see here, the VIX shot up today to 31.16 was the high. And to give you kind of a benchmark, there was pre-COVID in 2019, we spent nearly the entire year for VIX below 12. And as I've explained to you guys before, VIX is kind of the fear index. So when VIX gets as high, you get paid for premium, but if you've already sold premium, it's like a Dallas traffic jam. When we hit the polar vortex, what was it called? That we just experienced, where you guys saw that big crash. It was Brandon showed me a YouTube video of a big crash, and so it's like your options will get sucked up the premium and you don't get paid as much. So eventually when this relaxes, a lot of this premium that we've sold will come in and you can get paid. So our agenda today is I want to hear from you of what have you learned or practiced since we last met. And this is your chance to speak up. And I'll use my standard joke here, one at a time, please.
I learned you can lose all of your money very quickly.
You learned that you can have some big swings, especially when you're investing in meme stocks like GameStop.
Yes.
Right?
Right.
All right. What else? What else have you guys learned? And has anybody done any work in your development plan? I'm going to interpret silence as meaning no. Well, that is a lot of background information that you can go to kind of fill in a lot of missing information. And just don't expect that a 1-hour episode once a week will answer all the questions, but I have tried to put all of the missing link stuff into that development plan. Anything else that you've learned since we met last week?
I've learned again that the market is totally irrational.
You've learned that the
I can
market
tell you that.
is totally irrational. You know, there's a quote that I like a lot. The market can be irrational longer than most of us can remain solvent. And, you know, even some billionaires have learned that lesson as they tried to short GameStop, right?
Yeah.
Okay. Any other key insights, key learnings from this week? Well, once again, our plan is to learn one trade a week for 7 weeks. Today, we're going to be learning about selling a poor man's covered calls, creating an accountability plan. And let's look at who's in first place in the leaderboard. Here's a clue. If the glove don't fit, you must have quit.
OJ.
OJ, the juice ball. And I don't think he, is here to defend himself, but he's looks like in first place, the juice ball. And James, if you guys remember James, a lot of folks last week said, or 2 weeks ago said, hey, we just buy what James tells us to buy. So it looks like James is an upcoming guru there. So he's in second place. Alex, good job, Alex. Shout out to Alex, my fellow comic friend who's in third place. Charity, who is joining us virtually, is in fourth place. Ron, good job, Ron, kicking up fifth place. Okie Brock, who is my nephew, who's in sixth place. TJ is in seventh place, or Tejas Tommy. And Nada, who's joining us from Malaysia virtually, is in eighth place. And Chris Mutafov, my Bulgarian friend, is in ninth place. And Mike, is my business partner, is in 10th place. So trades that worked this past week. And I don't think OJ is with us, is he?
I'll see him.
Okay. James is here. So looks like Juice Ball you can kind of look up here and see some of the trades he made that helped to contribute to his being in first place. James, you want to talk to us about your selection of Riot or XNet, or what you were thinking when you made those trades?
Yeah, can you hear me finally?
I can.
Nice. Okay. Yeah, so pretty much on Monday, we just kind of noticed the value of Bitcoin was going to go down throughout the week.
Okay.
And so I hold a lot of like Bitcoin miners and related stocks. So pretty much I just shorted everything that I own.
Okay.
And it worked out in this fake money thing.
All right.
That's my life.
So both Riot and XNet are Bitcoin related.
Yeah, Riot's a Bitcoin miner, so they get paid in Bitcoin. So if the value of Bitcoin goes up, Riot goes up.
Right.
XNet is more of like a mining software, so not as much correlation.
Okay.
But it's still pretty related.
Still pretty related. Have you guys read that Elon Musk has invested $1 billion of his cash into Bitcoin?
What? Really?
Yeah. And there for a while, he made more money on the appreciation of Bitcoin than he has in all of his cars that they've sold for Tesla.
Yeah, nice.
Now, I don't know if that's the case, but I think some of what Tesla's cyclical now is correlated somewhat to Bitcoin, given the fact that he said that he felt better at holding Bitcoin than he did holding cash.
Yeah.
Alex, you want to make any comments of, looks like you benefited from a Tesla, selling a naked call on Tesla, right? A bearish position on Tesla, right?
Yeah, I did. And this was when everything started going down pretty quickly. I think on Tuesday, I went in on Tesla, Mara, and Riot. And all of those paid off pretty quickly. I was able to get below the 50% in it in a matter of about 14 minutes.
Nice.
So we went ahead and just closed those bad boys up. And turned around later in the day, tried to do the same thing with Mara and Riot again, and the tides turned on me, and I gave up a lot of that profit.
Gotcha.
But then Norwegian Cruise Line is the other one, and I just saw the monthly charts starting to go up, and it was having a good day in after hours or pre-market, and so I went ahead and took a put on that one, a bullish side of it, and close that out in about a day.
Okay. Wow. So a lot of erosion fast. Norwegian Cruise Lines LCLH, and you sold a naked put on that. Am I correct?
Yep.
Okay.
Correct.
All right. So trades that nuked a few of us, and 2 words: game stop. I think, Bob, you were a casualty there, as well as Brandon, as well as myself. Anybody else that experienced that? Yeah. So you guys want to talk at all about that? I know Brandon, before we went live recording, asked me, is there anything to do there? One possibility is close it, but I gave an analogy there. And I think it's applicable to poker. They say that one of the most important things in poker is what cards you choose to play pre-flop. And so I would suggest that when you're selling naked puts, always ask yourself, how would I feel if I own this stock? And if your answer is you want to own it anyway, then wouldn't you rather have it at a discount? So selling a naked put, and if you get assigned, hey, you wanted it anyway. So on selling a naked call, you should ask yourself, would I mind being short at this price? And I think, Brandon, once you see it go to 140 and you were sold a call at, what was it, 70? 65, you might kind of, your willpower kind of shriveled up a little bit. But if you were comfortable being short at 65, then give it some time and see what happens. And as you put it, I think you're riding this one to the end.
Absolutely.
So in terms of accountability, I wanted to let you guys know that 80% of all New Year's resolutions get abandoned. 63% of gym memberships go unused. So you might pass that gym and go, hey, there's a gym I belong to that I never go to. So the question is, are you going to do your homework? And some of you have replied, I'll try. And I've told you, there's either do or do not. There is no try, only do or do not. Now, that may sound a little more like Abu on The Simpsons than it does Yoda, but you get the idea. So in terms of accountability, 17 out of 22 have completed all their assignments for this week. And I was even calling people today going and taking a picture. Hey, are you going to be on the board, or am I going to have to call you out? So we're trying to get people to get all their assignments done and put them into a category. So we did slightly better than gym memberships. So today, what we're going to teach is poor man's covered calls. And it's one of my favorite trades, especially in some smaller accounts. And what I would consider as a smaller account is probably anything between probably 15,000 to 50,000. And what a poor man's covered call is it uses option to replace the long stock. So the reason it's called a poor man's covered call is that you can get some leverage. And let's say you've got an account of $50,000. If I start doing covered calls in Apple and Facebook, I might get 2 covered calls, and that's all I could afford. Whereas if you use poor man's covered calls, you might get 5 or 6 bullish positions in a $50,000 account. So you can get more diversification. It uses less capital by using some leverage. It allows more diversification in some smaller accounts. And my favorite strategy is to buy the 70 delta option further out in time. So it's February 25th. So for example, if I was to buy it further out in time, I might buy something, say in June, a 70 delta option further out in time. Occasionally I'll go as far out and buy the December. Depends on if you're kind of bullish, short term, medium term, or longer term. And then what you do is you sell the 20 to 30 delta option closer in time. So you could either sell the next weekly or the next monthly. So you guys have been, most of you have been selling the option in March. So was that March 19th, Brandon? You just looked it up.
Yes.
Yeah, 19th. So you might sell the 20 to 30 delta option in March 19th if you sold the monthlies. So what this does is it takes advantage of bullish moves while giving you positive theta. So let me demonstrate putting on a poor man's covered call. And let me just open up my $1 million paper trade portfolio. The reason I'm doing it rather than the one that you guys are in is I've enabled this for after hours trading so that I could demonstrate things. So somebody give me an example of something that you're bullish on that's fairly liquid.
After today's market?
Yeah.
I don't know.
Anything, oh yeah. Anything that you think has been oversold and you would choose to be, you're bullish on it, let's say mid to long term.
I'm bullish on PEGA, PEGA.
PEGA. All right, I've not traded PEGA, but let's see what their option chain looks like. All right, it looks like all they've got are the monthlies. So let's do one by buying the June 100. Let's see what the bid and ask spread is. Because I haven't really traded it, I would assume that the liquidity is not great, and that's the case. It looks like there is a bid ask spread here of $1.10. And remember, Chris, I told you that a big spread between bid and ask is kind of like somebody taking a cab in Bulgaria wearing a Chicago Cubs t-shirt, right? So it's the hidden cost of trading. So I guess I'll go ahead and set one of these up here, but I also want to say that personally, I wouldn't trade PEGA in options because of the big spread between bid and ask. Because every time you're leaving.
Yeah, I would prefer to see one that you think is better. It doesn't have to be PEGA.
Well, while you're on that one, why wouldn't you do that? So is that not how much you would make every time it goes, or?
No, this is the difference between a buy price and a sell price is like what the money changer gets it for and what he sells it to you for. So there's a big markup.
So what are you looking at as far as when you're trying to do something?
I sent you guys a list of the most liquid underlyings, and Greg helped Bob upload it into Thinkorswim. And those are the most liquid underlyings. So let me give you, and I'm not trying to bias you, but let me just give you show you kind of what Apple and Microsoft are. Notice that the spread there was $1.10. And now look at Apple here. This one's
10 cents.
10 cents. So 10 cents over $1.10. So think anytime you're moving in and out of a big bid-ask spread, assuming you're like day trading that thing, it's the hidden cost of trading, because every time the market makers are just making too much money off of you because the markup is too high.
Yeah.
Yeah.
Are you looking at like if the 175 and the 165 there. Are you saying it's a dime per, and it's $1.75, so it's like 5%?
If I go to,
Is it a thing of the difference and the amount of the bid and ask?
well, what happens is in real life, usually you get the mid price.
Yeah, but I'm saying there's a 10-cent difference there.
Yeah. There's
Whereas
a 10,
if you go up to 0304 way up high, there's a 1-cent difference.
up here.
A higher.
Okay.
Up one more.
These
There's
that
a
are,
1-cent difference.
now, what I want to also caution you on is that after hours, these prices aren't necessarily representative, and anything that's a 3 and 4 cent is a lottery ticket. If you're buying it, it's a lottery ticket. If you're selling it, it doesn't give you much protection. It's just you may be doing it for capital efficiency. So, but yeah, if you see something that's a 1 cent difference, that's a good thing. And when the market is open, these highly liquid underlyings, it's not unusual for you to find 1 to 5 cent spreads. And you can move in and out of those a lot without leaving a lot of money on the table. And a lot of times people on Thinkorswim, they think about their transaction costs, but the hidden cost of trading is people who are trading highly illiquid options, especially if you're actively trading them. Buy, sell, buy, sell, buy, sell. There's somebody on the other side that's a market maker, and they normally get paid just making fractions of a penny, but off of you, they're making $1.10. Does that make sense?
Mm-hmm.
Okay. Somebody give me one. I could still do Pegasus if you want, Chris, but can somebody give me something that they think has a little bit more active trading volume?
Hey, Dale,
Yep.
I was just real quickly wanting to ask, so you're saying that the spread between the ask and bid should never realistically be more than like 50 cents to $1, right?
I think so. Yeah.
Thank you.
And the reason being is you may not think about it a lot, but if you're trading 10 contracts on something, 1,000 shares, and a dollar is like $1,000, right? So you got to beat, it's like a bookie who's overcharging the VIG, or playing poker in Dallas where the rake is too high and you can't beat the game. So you want to find a game that can be beaten, and part of the reason is to find a fair rake. So somebody give me a liquid underlying that you're bullish on. And if we can't get one, I'll go back to Chris's. What do you got?
I think Disney.
Disney. All right, that one's gonna Mickey Mouse. He's gonna be trading.
Mm-hmm.
All right, so this might be a COVID place.
Don't steal that, Bob.
Hey, are you bullish on Disney? Would you say long term, mid term,
On the opposite,
short term,
long term?
Long term. All right, let's see what we can do here by maybe we can buy the January calls 70 delta. Let's see if we can fit this one in. Here's a 69.8 delta. It's a high price stock. It's still got a bid ask difference here of 75 cents, but it's also trading 190 stocks. So, and I think if you did this during market hours, you'd even get a better bid ask spread. So let's look at that just for demonstration purposes. And here's a 69.8. So I'm going to buy this guy. And then I'm going to go here to the monthlies in March, and I'm going to sell the 20 to 30 delta call. So here's 21.1. So I'm going to sell that. Now, the benefit of this, Brandon, is that you can sell premium in this in March. You could sell it in April. You could sell it in May. You could sell it in June. You could sell it in July, and then they would continue August, September, October, November. You could sell this for 10 months. So,
But you have to sell it after your buy option. Is that right?
well, you would keep this long.
Oh,
And
I
then you
got
just sell this, you would keep this is the long, right? You would you would keep this 170 long, and
Oh,
then
yeah.
you would sell this one every month. So
I
think
gotcha.
about this as you've subleased a rental house, and this is you're renting it out every month at a strike of 207.50, and it's currently trading at 190.
So Dale, you
Yeah.
moved at lightning speed there, and
Okay.
I, as my teachers have always said, am not the quickest.
I don't
So
understand it either.
the way you do this is you go to the 70 delta.
Yes.
I'm very process driven. So like, can you explain to me? Show us what you did again.
Okay. I went out to January and I scrolled
Okay.
down. We're doing calls. These are poor man's covered calls. Keyword is call. I'm looking
Okay.
at the 70 delta here. So here's a 69.8. It's trading. It's a strike price is at 170. Disney is currently at 190. So that's what we call in the money.
Okay.
So the difference between 190 and 170 is $20.
Yep.
So I'm paying $38.25, but $20 of that is intrinsic value. The rest of it is the time value that I'm paying for it. If I just bought the call, that theta decay would be working against me, that time value. But what we're doing is we're collecting so much by renting this out every month that we're going to end up free rolling at some point. By free rolling, we're paying $38.25, but we're collecting $2, right? So $2 in March, April, May, June, July, August, September, October, November, December, for 10 months. That's $20.
Gotcha. Okay.
And at some point, we've paid off this long call, and now we're free rolling because there's only $20 of there's $18 of extrinsic value left in this. So what you're going to make is you're going to make money from all the rent, and then you're making money from the appreciation of Disney. Anything it's trading above 170 by January is profit. So Brandon, what would you just guess if I asked you to set the line on what you thought Disney just ballpark is going to close at by next January?
Year from now?
By next January, what would you guess?
I don't know. I haven't seen any charts.
Yeah.
I
Can
don't
you
know,
look at
but
it historically?
I know they have a few things in the works. So, it could go pretty high.
It's currently trading at 190.
Yeah, I'm thinking.
So do you think it'll go up 10% in a year?
I think it'll go to 220, 225.
All right. So if it did, what happens is you own an option to buy it at 170. If it goes to 220, then you've made $50 on the underlying, and you've collected $2 a month for a year. For 10 months is an extra $20. So 20 plus 50 is 70 times however many contracts you've got. So if you just did one contract, 70 times 100 is you've made $7,000. And in this case, on a smaller amount of investment. So Here's an example. Let's find out what the investment would be. So we're buying this guy. Was that slow enough, Chris?
Yeah, it definitely was.
Yeah. All
But
right.
hold
Hey,
on.
Dale,
Keep going slow, because I'm just going to try and mimic this trade right now in real time.
Yeah. Okay.
So
We're buying the 170 and we're selling the 207.50.
I got a quick question, Dale, if you don't mind, before
Sure.
we find the total cost. If we're long-term bullish on this, which is why we're buying the call, and so we think over time it's going to get there, why are we not taking the put side on the sells? You see what I'm saying? Aren't we working against ourselves? If we're bullish on the sell side, we should be selling puts, not calls.
Well, there are 7 different ways, and there's more than one way to skin a cat. Now, why do you want to skin a cat? Well, there's more than one way to put on a bullish trade. The first one I've taught you is selling naked puts. The disadvantage of selling naked puts is the most you can make is the premium that you collected. The advantage of doing a poor man's covered call is that you can make money off of the long call that you bought, and you can make money off of the premium that you sold.
Yeah, no, I'm not questioning the long one, the buy side. I'm questioning it to fulfill what we suspect is going to happen on the long buy. Wouldn't our percent of in it on all of these short of all these sell calls that we're doing, aren't those actually working against? Isn't the percentage going to go up? You see what I'm saying? Like that's the part that I thought the whole sell of a call period, no matter what, is a bearish idea.
Selling a call is bearish, but primarily here, what you're really trying to do is just pay for your long call in a way that gives you a positive theta trade. So if your question is, can I use puts to create a bullish trade? The answer is yes. It's not one of my favorites. Personally, I prefer to use puts when I'm creating a bearish trade, a poor man's covered put. And that's what I'm going to teach you next week. So let me just bring over, I'm
also a little confused with what he's saying, because
okay.
it seems like he said, if we're trying to be bullish on it, would we not want to sell the put versus sell the call?
Selling puts is a bullish trade, but what a poor man's covered call is you really want to do a covered call, but you can't afford it because I'm a poor man. So what I'm showing you how to do is to still do that trade by using the long call as a synthetic long position. Now, yeah. I'm gonna teach you here 7 of my favorite trades. You may have 7 others that are different. I just happen to use these most often in the trades that I make. But selling a naked put, the risk graph is similar, but you're constrained by what you can make to the credit that you've collected. Now let me put on that same trade in toss, and I'll bring over the analyze tab so you can, and I think this might help you to be able to visualize it. So I'm going to go here and we'll do Disney, the one that we just established. And I'm going to go here and buy a little shorter term so you can visualize it's the 70 delta call here. Here is a 68. So I'm buying this guy and I'm selling the 20 to 30 delta. So here's a 21. So I'm going to sell it. Now I'm going to, if I did 10 contracts, this would take me $15,000. So roughly it takes you $1,500 per contract to establish. But let me show you and also what I'm teaching here is if you use TOS, use this Analyze tab to create, and then what you can do is you can, let me readjust this. Can you guys see this chart?
Yes.
See this chart? Okay. What I'm going to do here is always make sure that this number here is today's date, and this top line is the expiration of your short. So in this case, it's March 19th. So I'm going to change this to March 19th. And this shows me that I could have a 47 point, let me, %47 probability of profit. But the thing is, I'm able to sell premium multiple times. So what you can do is you can slide this and you can look at the price of Disney, and you can see if it's at that price on this purple line, it's how much I would make today, and if the top line is how much if it's at that price at expiration. So what I wanted you to do is to encourage everybody to use this Analyze tab as you create a trade to see what it looks like, and then you can begin to visualize what it would look like depending upon what the price does. Now, Alex, do you want to give me a put trade that you're proposing to set up?
Could we stop on 1 second here?
Sure.
No, with TOS. Right now it shows break-even point 190, but 190.99, yeah? So, but because we have two different expiration dates,
yeah.
So are you sure that TOS shows that break-even point correctly for us? Because I'm not sure that it's correct.
You're not sure if those percentages are correct?
No, I'm not sure about that 190.99 as in our break-even point.
Okay, well, it's currently trading at 190.98.
Yeah,
and you're questioning whether 191.30 is the break-even point?
Yeah, because it doesn't make sense to have that poor man covered call just because we have that break-even point so close to current price.
Well, if you don't like it at that current price, you could restructure the trade.
Yeah, but if you change, for example, 180 to 170, yeah.
Okay.
You see, you have slightly different. So you have different break-even point, but when we have expiration, we don't close our trade completely, correct? So we have to make next step until we reach April 16.
Right.
So it means our break-even point for whole trade will not be in that place.
Yeah, I'm not exactly following what you're saying. If it's questioning the validity of TOS, that's outside of my the scope of work for this meeting. Let me go ahead and set the one up in January, which actually I like on this one to show you this guy. So let's do the Analyze tab on this one. And TOS, you may say, well, 50% is not impressive, but you get 12 shots to sell premium. So anyway, I wanted just to demonstrate that in terms of the poor man's covered call. And I'm looking at kind of, I'm being attentive to my time too, because I want each one of you guys, I don't want to spend over an hour. So let me see where we're at here. So your assignment this week, and then I'll go ahead and take questions, is to create 2 to 3 poor man's covered calls and put them into categories. So let me go ahead and bring up on trade diff, because I think some of you, you might find this interesting. Is I'll show you some real accounts that I have some poor man's covered calls in, and give you the size of the account so you can kind of get an idea of how many trades you could have on. So here's kind of, let's see, my wife's non-IRA, and you can see here that here's the way you put things into groups. So this is a bearish put diagonal. So I'm going to put GameStop in there. And here, as you can see, in a $98,000 account, there's 6 different poor man's covered calls. You can also click on this and you could bring in all of the premium that I've sold in the past and kind of see how that underlying, so you can see Google, you know, its total is up 6,800, but all of this premium has been collected in addition to the premium that I've collected from the underlying. So the benefit of a poor man's covered call is you can make money on the premium that you sell as well as the appreciation of the underlying, but it's a positive theta trade. And so essentially, somebody explain to me your understanding of what theta is. What is theta and what does theta decay mean?
It's probability.
It's probability?
Yeah, so it's sorry, theta.
Theta.
Yeah, it's time, how much time we have until expiration, and based on that one, how much money we get if we sell call or put, or how much money we will have to pay if we buy call and put. So it's time is money. Money is time.
Here is the Bootcamp challenge. Juiceball is collecting $1,524 a day in theta decay. My analogy here is if you leased out a condo for $3,000 a month, you would roughly collect about $100 a day in theta decay. Theta is theoretically what you can keep, all other things being equal. So it's time. Remember, the time is on your side. If anybody would break out into song here, I believe, Alex, you did that in your comedy routine at some point. You know, it's something about Disney, right? But time is on your side. So it's every day that passes, you're forcing the market to beat you. And every day that passes, you're collecting that amount of money. So Juiceball, the market's got to beat him by $1,524 before he starts to lose money. Alex, your theta decay is $464 a day. James, yours is $206 a day. Key question is, how could I raise my theta? Sometimes you raise your theta by taking on risk, and you don't want to necessarily take excessive risks. Charity is $7 a day. Ron is $98 a day. So I can go into.
I don't know where you're getting those numbers, Dale.
Okay.
They're not on the board.
Yeah.
As far as I can tell.
They're not on the. Oh,
you're not showing them.
I'm not showing them. Okay, let me share my. Sorry about that.
It's the middle one on the Greeks when you look at the leaderboard.
Yeah. If I'm going to go into our contest. Okay, can you see my pointer?
Yeah.
Okay, it's the middle number in the Greeks. If you hover over the Greeks, it'll tell you what is what. So it's delta, theta, and vega. The most important.
Is making $1,500 a day.
Yeah, in theta decay. And Bob, you're currently making 566. And that is the benefit to being an option seller, because you're collecting some money every day. So somebody who's an option buyer, they're paying that amount per day to gamble that they're going to be right. And if they're not right in a certain period of time, they run out of money. How can you be patient? It's costing me too much. Remember, you were talking to me about investing in the VIX, UVXY, and I was saying the downside is the cost to carry is so high that to stay in that trade, you have to be right pretty quickly, or you can't afford to stay in that trade. That's what people are doing when they're buying options, and that's why I'm such an advocate of primarily being a seller. Now, poor man's covered calls is a spread, but every time I buy something, I'm selling something against it that will make money every day in theta decay. Now, I know that theta decay it's a difficult concept to fully grasp. So I would encourage you, if you watch any videos on the development plan, watch those videos on theta decay. Questions? We got 10 minutes. I can take questions. Could be real trades that you're trying to structure, explaining something that I wasn't clear on.
When poor man covered call should be adjusted if something goes wrong?
When should you adjust poor man's covered calls if something goes wrong? You know, what do you want? What? Give me a scenario like the.
So, if we imagine that Disney goes below our long call strike.
Yeah.
Before we.
One of the things that I always am alerted to is if you look at your theta numbers and they're no longer positive, then something has gone off on your trade. And occasionally that can happen. It can go so far that it's below your call side. Now, what happens, and this is good news, is sometimes it's happened to me, for example, on Apple, you know, it goes up so much that your long call, you're just holding so much premium in your long call that it's time to roll that up to 70 delta. And you can capture a lot of cash because I'm leaving too much kind of invested in that one long call. Normally on a long-term bullish position, I will only adjust the long side maybe once a year under extreme appreciation, but that's a good problem to have.
Can you go back to that Disney trade?
If your premise changes, just close the entire trade. If something happens that causes you to question your fundamental premise upon which you base that trade. Let's say you invest in Boeing and now all of a sudden airplanes start going down and you believe their brand is at risk, you know, just close both sides. Bob, you want me to go back to that Disney trade on toss or on trade diff?
On trade diff.
Okay. You want me to put it on?
Yeah,
okay.
But I'm going to ask you a question while you're doing it.
Okay. All right.
So this is the first part.
Okay.
You're buying a call, right?
Yes.
So now in like layman's terms, what are we doing here?
Okay. Really what I'm doing is I'm replacing long stock with an in the money call.
Say that slower.
Okay.
The stock is at 195.
All right. Here's an example. If I went to buy 100 shares of Disney, how much would it cost me? 100 times 190. So it cost me $19,000 for 100 shares.
Right.
Let's assume I don't have $19,000 to dump into Disney, but I'd still like to get some spoils from the appreciation of Disney. So instead of buying the stock, I'm going to buy an in the money option to buy that stock at 170.
So the stock's at 190. You're buying an option to buy it at 170.
Yeah. Anytime
So you'd be
within
making anytime.
anytime between now and expiration, I could step in and I could buy that stock at 170. Okay.
So Dale, look, I'm very, very, very process focused, unfortunately. It's just the way that I organize my thoughts.
Yep.
The first step of doing this is finding something near 70 delta, right?
Yes.
If the strike price at 70 is 170 and Disney is trading at 90, you can always buy it at 170 as an option.
Disney is currently trading at 190. Anytime between now and expiration date, which is January 21st of next year, you could step in and buy it for 170. Now, you're not going to want to do that until the day before expiration. So why would I spend the extra money if I don't have to? You know, because as soon as I have to pay $170 multiplied by 100, I got to give you $17,000 of cash. And why should I do that until the last minute? Time is value, you know, cash is valuable.
Yeah, for sure.
Okay, so you're buying the option for 100 shares. You have, and how much? That's.
And I'm paying $37.90.
A share.
Doesn't the stock have to be at 170 to get the stock at 170?
Just a second. No. Let me take these one at a time. So instead of paying $19,000 for 100 shares of Disney, I'm paying $3,790 for a contract to purchase it at 170. So instead of paying $19,000, I'm paying $3,800. So roughly, you know, 1/6 of the amount. So Nancy, ask your question again. Doesn't it have to be at 170?
Yeah, no.
Well, it needs to be above 170 before I would ever exercise this option, because I'm not going to exercise an option to lose money. So the only time I will step in and buy it at 170 is if the price at expiration is higher than 170. I'm not going to lose money. Let's say that the price is at 169. I'm not going to buy it for 170 because I could buy it on the free market at 169. Why should I exercise to buy something at 170 if it's at 179? On the other hand, if it's trading at 180 and I can step in and buy it at 170 and sell it for 180, then I've made $10.
Realistically, we wouldn't want to exercise this trade though until it hit right around 208 a share.
No, you will exercise this even if it trades at $170.01, because you'll make money. I mean, you buy it for 170, and you turn around and sell it for whatever it's, you know, it's trading at $170.10. It may not seem like a lot, but 10 cents times 100, you'd make $10. So
Dale, am I buying a put?
What you may be really asking is, at what point is it profitable? Is that really what you're asking? Or
Correct.
When would you exercise it? Truthfully, I would just close both sides of it. I have never exercised, I know this would sound weird, I've never intentionally exercised a long call. The day before expiration, I'll just close both sides of it. But
Dale,
the option will have all that intrinsic value in it. So if let me answer this first, Chris. If Disney is trading at 180 and my option is 170, there will be $10 of intrinsic value the day before expiration that's in that option price. So you really don't have to exercise it. That value is in the value of the option. Okay, Chris?
All right. So the first step is you find a delta of about 70.
That you buy.
Then what do you
further out in time?
Buy? Okay, right. You go to January, and I buy a 170, right?
You buy the 70 delta option, which in this case is a strike of 170.
So show me how you do it. Sorry.
All right.
I need to watch it on the screen. Is what I'm saying. So like,
let's do another one. Here's Apple. And it doesn't have to be January. It's just further out in time. I picked January because Brandon said he's long-term bullish. But let's try, Apple in June. A June call at 70 delta is a strike of 110. There's a 30-cent difference in the bid and ask. I'm going to buy this guy 110. I'm going to sell
100 shares there, right?
One contract is equivalent to 100 shares.
Right. Is anybody else getting an error on theirs? Mine says violation, contest does not allow, call, and put buying only.
Okay, and here's the reason. You have to put both legs on before the violation goes away. The reason for the violation is we do not allow you just to buy long calls. So it has to be part of a spread. So when you put the second leg on, it won't give you the violation.
So how do you put the second leg on?
You go and you click on the second leg. So in this case, March 19th, and I'm going to go down to the 20. So in this case, if I was working yours, it'd give me the violation. So, and then I go in and I find the 20 delta, and I'm going to sell this guy. Once you get the second leg on, the violation will go away. You do not have the submit button because you're not allowed to make trades after hours.
Okay. Why are you buying the second leg?
Why am I buying the second leg? Because if I just did this first leg, theta would be working against me.
Correct.
And so I don't want that. So I'm always selling something against it in order to have positive theta and in order to have a high probability trade so that I can be the casino and not the gambler. If all I did was buy that long call, I would be the gambler and not the casino. So let me go here and show you. I'm buying the 70 delta call, and let me show you what theta. Every day I hold this trade, it's costing me $2.30 every day for a year. So by selling something against it, now what I want you to see is now all of a sudden, my theta is positive $5.70 a day.
What are you giving up to do that?
You're giving up a potential upside for a guarantee income.
Okay.
Gotcha, guys. I'm sorry, I got to jump.
All right.
But Dale, that was great. Thanks for walking me through that. I will do that trade tomorrow morning.
Right.
Hey, Dale.
Yeah.
Can you comment on the overall strategy of a poor man's covered call is to want the price to stay the same or go down?
It's a bullish trade.
It's a bullish trade. Sorry.
It's a bullish trade. And you hope in all bullish trades, you hope it goes up. And how this is different than a naked put is in a naked put, the maximum you could make is the credit you've collected. In a poor man's covered call, you can not only make money off of the credit you're collecting of what you're selling against it, but you're also making money on the appreciation of the underlying. So you're making money in two ways.
So you really want to sell the put, sell the call, you're selling the call to make the money, right?
Primarily, but you also want to make money.
to
You wanna-
protect yourself.
I'm sorry, go ahead and complete your question.
So you're selling the call, the 20% call, right?
Mm-hmm.
To make money. And we're buying the call to protect ourselves in case the stock
You're
goes
hoping
down.
you're hoping to make money on both ends. So let's assume that I sublease a property, and at the end of that sublease, if that property has appreciated, I can actually make money off of the underlying property. And I can also lease it out, sublease it out to Airbnb. So what I'm hoping to make money two ways. I'm hoping that the property appreciates, and I'm hoping that I may have good renters and I collect rental money every month. So what you're hoping with Disney is it goes to the moon and you step in and buy it at 170 and you're selling it at 220 and you made $50 on the underlying, multiplied by 100 shares is $5,000. And you made $2 a month selling premium against it. So you're hoping to make money both ways.
So you're making money on the call. If it goes up, you make money on the intrinsic or the value of the stock.
Yep.
You're paying theta, but you're making theta on the selling.
You're making more theta on what you sold than you're paying for what you bought.
Gotcha.
Yep. Good question. Anything else? All right. What I'm going to do is I'm going to go ahead and stop the recording.